Good morning and welcome to the Killik podcast for Friday the 28th of November. One big piece of news this week, and that's the OPEC meeting in Vienna. We've seen a big fall in Brent over the last 3 days, particularly yesterday, which is now down 10%. And that's on the back of OPEC maintaining their current production rates per day. We've seen heavy falls across the oil stocks and the currency of the oil-producing nations, particularly the Russian currency, which is down 3.6% against the dollar. So let's just spend a little bit of time on OPEC. 12 members, they supply a third of the global production. At the moment, they produce 30 million barrels a day. They've got varying fiscal positions, so they've got different rates of oil price that they would like in order to balance their budgets. And as you can see, Saudi, for example, is far stronger fiscally than Venezuela or Iran. So this move by not supporting the oil price yesterday has created a little bit of friction within OPEC. So what are the near-term effects of this move? Well, it's more the absence of any supportive language that came out of yesterday. So the market's taken this to mean that the risk of oil prices moving lower is substantially increased. So this is negative news for the entire oil complex. So exploration and production companies will suffer because it'll be uneconomic to bring projects on at higher costs. Integrated oil companies are suffering because their free cash flow is falling, and therefore they need to reduce their capex in order to pay their dividends. If they are reducing their capex, service companies are going to suffer. The traditional relationship is a dollar fall in oil is matched by a dollar cut in capex, so that's clearly bad for those names. The longer term implications are, if OPEC is not going to support the oil price, then the oil price is going to be more volatile. If it's more volatile, you're going to destroy supply. And more volatility will lead to increased substitution away from the oil price. You've also got increased chance of civil unrest, particularly in nations where they require high levels of oil in order to maintain their fiscal budgets. So we've got Venezuela, we've got Iran, but you've also got Russia, which needs $110 per barrel to balance their budget. So where is the floor? Well, we haven't got a meeting till next June at the moment, so there's considerable time for further speculation and uncertainty. At the moment, the oil market is oversupplied to around the tune of a million barrels per day going into next year. And the floor is really where the variable cost is. And if you go to the lowest cost producers, that's US shale, they're producing at $40 a barrel. So there potentially is room for further weakness in that oil price despite the big moves so far this year. Falling commodity prices are feeding into inflation, and we got some very weak inflation numbers in Germany this week. So 0.5% year-on-year increase, which is a 5-year low in terms of that inflation rate. And underlines Draghi's statement in November, back on the 20th, saying it's essential to bring back inflation and without delay. So as you can see, the market's been pumping a lot of liquidity into the bond market in anticipation of QE, and German bond yields are now at 0.7%, which is something like a 5-year low and well below the UK and the US rates. So this is starting to price into riskier assets in Europe, and we've seen a decent rally in European equities, but it's probably worth just pointing out that with sovereign rates down where they are, corporate bonds are actually, and corporate debt is now very cheap. So for some of our UK and European stocks that we like, you can see a significant spread of the dividend yield against the cost of financing. So these companies are financing at 1.5%, and they're paying equity holders around above 4%. So what we'll probably see is continuing use of debt in order to buy back shares, in order to reduce that equity burden, but that's good for equity holders. So here you can see the relative 10-year gilt, which has also been very weak this month against the FTSE, and that just goes to strengthen the relative appeal of the equity market in the UK. On the corporate news, we had BT Group, which has accelerated its move, well, potentially is going to accelerate its move into mobile with potentially buying O2 or EE. Also interesting was the Advanced Wireless Service Spectrum auction in the States, which is the auction for the next piece of spectrum for data to travel over. The bids for that have meant that the price has doubled for that spectrum since 2008. Just shows you the big effect that more data going over networks is having on the real estate in that sector. The week ahead, we've got Aberdeen Asset Management on Monday. We've got Tesco's Wednesday. We've got TUI Travel, which will be interesting post Thomas Cook and Harriet Green leaving this week, and we've got Berkeley Group. On the macro, we've got some manufacturing data in the US and Europe. We've got a bank rate decision in the UK and the ECB. Both are expected to stay on hold. And then we've got the non-farm payrolls in the States. Just looking at next week, Berkeley has been suffering from a political discount. It's obviously concentrated in London and more affected by the mansion tax. So we'll see how they're feeling about the London market next week. And also Tesco's, and it's just worth spending a tiny bit of time on the Aldi and Lidl effect. You know, it's been well documented that Aldi and Lidl now have 7% of the UK market. It's also worth stating that typically when they go into a new European market, they look to get into the low teens. So let's say they got another 5% of sales from the big four. That's equivalent to around 750 million of profit. So in the context of Tesco's free cash flow, which is about 420 million in 2014, that's still quite a big number. So we'll be looking to those numbers with interest. Thanks very much. Have a good weekend.